We're going to get the spoken word on growth now from our Chief Equity Strategist, John Blank, who joins me via Skype from the West Coast. John, in a recent article for Zacks.com, you wrote that growth is not enough. The most overstated concept in international investing is the idea of growth. Why?
Terry, the problem with growth rates is people use growth rates to compare stock markets and countries. And the truth is that there's no value in that exercise, really. The value is in taking a nominal growth rate for a given country. For example, China. Let's take China with a 7.5% GDP growth rate and a 3.5% inflation rate. Then you've got an 11% nominal growth rate in China. That's the benchmark for whether a revenue growth rate of a Chinese company is doing well or poorly. So the right way to look at growth rates is to use them as what a solid performing company within that domestic market should achieve on its revenue growth. So the point is, for example, a Chinese stock has got to be doing at least 11% revenue growth to be interesting, because that's what the economy is doing. But there's no value in saying, let's buy China and not Europe because the growth is stronger, because there's just simply too many other factors that are playing out in that whole context.
And so that's why basically the growth-only concept does not work?
That is correct, Terry. I mean, the other example would be, let's take Indonesia, which has got about a 6% growth rate at the moment. That's lower than China, but they've also got an 8% inflation rate. So in Indonesia, if you want to buy a company that's doing average, you've got to do a 14 to 15% growth rate. So here you've got a lower growth rate, but a higher bar for company performance. And then you take Europe itself, you got a very low growth rate, but you have multi-year highs in German stocks. You have multi-year highs in Netherlands stocks and Norwegian stocks. And you have, Zacks ranked #1 Swiss telecom companies. You've got plenty of opportunities there that are companies that are well positioned and properly valued. So once you layer valuation into the game, risk into the game, inflation into the game, you really see the big picture with growth.
So you mentioned nominal growth a while ago, nominal growth tracking. What does that mean for investors?
What it means, Terry, is, at the end of the day, you're buying the solidest picture for your pickup in earnings, which is what drives estimate revisions in the Zacks rank, has to come from the top line, or sales growth or revenue growth, however you want to call it. So revenue growth, at the end of the day, Terry, that idea, if you want to believe in the basin of performance that your company is operating in is its domestic market, and that nominal growth rate is high or strong, that's giving you some confidence that that company really can deliver earnings upside going forward, and that fundamental is what can drive your share prices. That's a Zacks rank view, and it's got firmer support than monkeying with tax rates or currency translations and other things. So at the end of the day, it's all about revenue growth if you really want solid performance, and that means you got to get the nominal growth rate right up front and center in your thinking.
So while investors need to be aware of this, what's the bottom line for them as far as investing globally goes?
Terry, global investing is about staying diversified, and you've got to be diversified by country, by region, and by industry and sector. So the right way to think about it is to pick the best performing ideas that you have in each of those regions and make sure they're in different industries across the globe. And you've really got a way to get that outperformance without taking on so much risk. And that's what I would recommend.
So what you're actually saying is apply old school techniques.
Absolutely, Terry. I mean, there's nothing new, novel about that idea, but the execution of it gets critical in international markets because you've got currency risk, you've got political risk, you've got all kinds of issues with different valuations that are out there. All of that being traded off on a relative value context, you really need to lower that risk through diversification, and that's critical in these markets.
I thought I was the only old school person around here, John.
Terry, I maybe look young, but I've been around the block a little bit.
All right, we won't go there. That's the spoken word on growth from our Chief Equity Strategist, John Blank. With John, I'm Terry Ruffalo.